Hello, folks. In today's lesson, I'll be teaching about the whole market structure and how to trade your structure. Let us look at the structure that we have for a moment before I start. We have seen that the structure has given us a high and a low. Remember, this is our 30 minutes time frame. So I just want to explain what is happening between this high and this low, so that maybe someone who's trading at home who doesn't understand what most of the time traders look at before they execute the markets should also look at as well. You see, we always talk about the liquidity, and most people, they don't understand how liquidity is generated on the structure every time when they start to analyze. But they all see the highs created and the lows created between the extreme high and the extreme low. But they really want to understand why the price has to move like that from that high to this low, and why the market has to move from this low to go up there. Why is it like it's always moving like that, like every day? And you see it like it has to move like up and down, like you have to analyze it and go with the direction and all that. Why are we supposed to be trading all that? So you need to understand that in a time frame of 30 minutes, the structure of 30 minutes or the structure of 1 hour, the structure of a daily, there is always the highs and the lows created in the market. So if the market was selling, giving us those high lows, higher high, higher lows, higher high until this zone here, you should understand that between the high and the lows that are created by that market in that time, that is liquidity. Between this high and this low, what is happening between here is liquidity, which means that if the market has to buy to wherever that is buying to, it is taking out all the liquidity that is created with this whole structure of the downtrend. So when you come as a trader, you want to trade this whole liquidity, okay? You know very well that this is a buy side liquidity, all right? Like it's the trend liquidity. So if it is a trend liquidity, you have to know how to trade this trend liquidity. So let us look at this down movement and see what is happening there. In this down movement, we have seen the market breaking our low up here, all right? Which means here, the market was confirming that it's changing character of bullish, now it's becoming bearish, all right? On this structure here, we have a bearish momentum. So if we have a bearish momentum on that structure, it simply means that we have broken that low, and then the market has to push from where it is, from that break of structure, up to this zone here. So what was there when we remove this? There was an efficiency here, all right, which means there was a little bit of an imbalance there. The market has to come and close that imbalance, and then the market has to give us all those momentums there. But before we look at that momentum, I want you to take a look at what is happening below here. So the market clearly created this low. Like this low had the whole liquidity on it. So the market has to come and create this whole sell side liquidity here as well. Okay. So the market now took out that liquidity and went out, creating some rallies to go down there. All right. And then we saw it creating this high here. All right. And this low here. Okay, which means this high is our liquidity that the market is just going to have to target as well. All right, this high it carries liquidity as well. The market has to target it. And then we have this low here that has been taken out by the market. It had liquidity, right? So let's say it in a simple manner. When you have identified your high and your lows, you have to also identify the equilibrium of this whole structure. All right. Like, where is the market right now? The market is it on the equilibrium or above the equilibrium? So we have to be knowing the reason why we are selling, and we should know the reason why we buy. The reason why we identify the equilibrium is that we have to know if we have already mitigated the premium, because you cannot buy from the premium, you have to sell from the premium. So if we are on the premium, we have to look for sellers. If we are on the buy or on the discount, we have to look for buys. So you can see that the market in this circumstance now, the market is at our 50%. Like, it hasn't really mitigated the 38% of the premium, because that is the zone where the market has to pull back to close whatever liquidity or that is left on the discount, okay, or the equilibrium. So on the 38% that you see, which is the zone for on the premium, you can see that the market has a supply zone which is that high there. All right, that is the high that we have. We have a supply zone there. I want to zoom in so that you can see. So I will explain again what a supply zone is. A supply zone is the last candle created by a momentum on the premium zone, right? So it's the last candle that was created. So the last candle in this structure, it is that bullish candle, because from this low to that high, the market had that last bullish candle. So that is the order block that the market is looking for now. Okay, so when you look at that structure, you see the market now is going to that order block. And then the next target that we have from here, it is this whole efficiency that we see here. Okay, we see this whole efficiency that is an imbalance down here. So the market now will want to look for this imbalance here to fill this whole imbalance here. So on these candlesticks, you should understand this, that there are there's a lot of liquidity on this candlesticks that mitigate as well, and some unmitigated order blocks as well. So we have liquidities, like we have a fair value gap that has been created by the market here. Okay, and we have some liquidities as well. Let's just zoom here, which is the trend line liquidity as well. And then we have that liquidity as well that you see there, which is down here. Okay, this is our liquidity as well. And then we have the last candle that was giving us the sellers. Okay, that is the last candle there. And on that candle, we have what we call a fair value gap or an imbalance here. So which means the market now will always look for those efficiencies either on the buy side or the sell side to try to mitigate them. All right. The liquidity has always been created on the internal structure of the extreme high and the extreme low. So when you open your charts, you always have those extreme highs and extreme low, so that you can able to identify if you are trading the internal structure, or you are trading the structure which is between the extreme low and the extreme high. So that is very important to identify your highs and your low, so that you can able to do what? To be able to have a nice market structure. So on this zone here, we are going to see the market coming all the way to mitigate all these zones by breaking that low, filling that fair value gap, looking for a supply zone here that is change of character, and it will come to this discount, and then we can look for buyers there. So that is what you should understand, guys. So as for the internal liquidity, there are a lot of things that you guys have to understand. But since I had a short video today, I just wanted to show you how to identify your highs and your lows, your internal liquidity, and how you execute as well on the premium and the discount. So until next time, I'll be teaching you again how to deal with the demand the next day, which is tomorrow. So thank you so much for your time, guys. And I love you. I love you so much.